Start with energy, explain with authority, highlight with emphasis, and with warmth. 7.24 USD, down 0.46 or roughly 5.92% on the intraday session as we speak on this Monday, December 1st. If you are just tuning in and seeing that red percentage on your screen, your first instinct might be to assume the rally is over. You might look at that number, a nearly 6% drop in a single trading session, and think the gravity of the housing market has finally caught up with Opendoor Technologies. It is a reasonable assumption. After all, we are talking about a company that has been arguably one of the most volatile assets on the Nasdaq this year. But if you stop your analysis at the red number on the dashboard, you are missing the massive, submerged iceberg of financial engineering that is currently playing out underneath the surface of this stock. The expectation right now, the lazy narrative floating around the message boards and the surface-level financial blogs, is that Opendoor is simply correcting after a speculative meme run. They see the chart, they see the pullback, and they assume the hype cycle is dying. The reality, however, is significantly more complex and, frankly, much more interesting. What we are witnessing today isn't just a simple sell-off, it is a recalibration following one of the most unusual corporate actions we have seen in the mid-cap tech space in 2025, the distribution of tradable warrants. We are not just looking at a home flipping business anymore. We are looking at a company that is aggressively attempting to re-rate itself from a capital-heavy real estate operator into a capital-light software platform, all while conducting a masterclass in shareholder structure manipulation. Today's drop to $7.24 needs to be contextualized against the fact that this stock was trading at 50 cents, literally 50 cents, just 6 months ago in June. You are looking at an asset that has effectively pulled a Lazarus maneuver, rising 1,000% from its lows, and today's movement is the market trying to figure out what the new normal is now that the warrant dividend has hit brokerage accounts. Let's zoom out and look at the immediate price action we are seeing on the tape today. The volume is heavy, significantly above the average daily trading volume we saw back in Q3. This tells us that there is a turnover in the shareholder base. The fast money that rode the momentum up from the single digits is likely cashing out, locking in those 10x gains, while a new set of institutional eyes is looking at the entry point. When you see a stock down 6% on no specific negative headline news, no SEC filing, no disaster earnings report dropped this morning, it usually signals a technical flush. It is the exhaustion of the buyers who have been piling in since the new CEO, Kaz Nejatian, took the reins. Now, let's confront the elephant in the room that most people are glossing over: the shopification of Opendoor. The general belief, the expectation, is that Opendoor buys houses, holds them, prays for appreciation, and sells them. That's the iBuying model that Zillow abandoned and Redfin ran away from. If Opendoor was still just doing that, this stock would likely still be under $1. The reality that is driving the smart money right now is the pivot toward exclusives and the software platform. Nejatian, coming from Shopify, isn't interested in owning billions of dollars of drywall and lumber. He wants to own the transaction layer. He wants Opendoor to be the operating system for real estate, not the landlord. This disconnect between Opendoor the house flipper and Opendoor the transaction platform is where the alpha lies. The market is struggling to value the latter, so it keeps punishing the former. While we analyze this movement, I want you to take a second and look at your own portfolio. Comment below how many shares of Opendoor you currently hold, and more importantly, let me know if you held through the distribution date and received the new warrants. I want to know if you're holding the OpenW, OpenL, or OpenZ series. To understand why $7.24 is such a pivotal level, we have to talk about the macro environment that is squeezing this price action. We're sitting here in December 2025, and the whisper number for the Federal Reserve's meeting later this month is a rate cut. The housing market has been in a deep freeze for nearly 3 years. Volume has dried up because nobody wants to trade a 3% mortgage for a 7% one. But if the Fed cuts, the lock-in effect loosens. Inventory floods the market. For a traditional iBuyer, a flood of inventory can be dangerous if you own the wrong assets. But for a platform that makes money on the velocity of transactions, a flood of inventory is rocket fuel. This is the contrarian take. Everyone thinks a housing crash hurts Opendoor. In the old model, it did. In the new model, where they're trying to capture fees on every transaction rather than spread on the asset, a high-volume market, even with lower prices, is exactly what they need. Let's discuss the mechanics of how you might be interacting with this stock, because the retail interest here is undeniable. Whether you are placing orders through a robust Fidelity trading platform or you are swiping through on the Robinhood app, the user behavior around Opendoor has shifted. It has moved from a deep value play for distressed asset investors to a momentum play for tech growth investors. You see this shift in the chatter on SoFi Invest social feeds and the discussions in interactive brokers' stock trading forums. The retail investor is looking for the next Tesla stock or Nvidia stock, something that was left for dead but has a technological catalyst to propel it to new highs. Opendoor fits that psychological profile perfectly. It fell 90% plus, stayed there, and is now attempting a tech-led resurrection. But we have to be realistic about the risks, and this is where we need to strip away the hype. The reality part of our equation is that Opendoor is still burning cash. The Q3 earnings we saw last month confirmed this. Revenue was $915 million. That sounds like a lot until you realize it's down massive amounts year over year because they stopped buying as many houses. They missed earnings expectations, coming in at a loss of 12 cents per share versus the 7 cents Wall Street wanted. And yet the stock rallied after that report. Why? Because the market stopped caring about the current burn cash and started caring about the burn multiple and the runway. They saw that the cash pile is still sufficient to survive until the 2026 break-even target that Nejatian has promised. This is a classic expectations versus reality setup. The expectation was that the earnings miss would crush the stock. The reality was that the forward guidance regarding the software margin expansion was enough to sustain the bull run. When a stock stops going down on bad news, that is a change of character. That is what we saw in November, and that is why today's drop to $7.24 feels more like a pause than a reversal. Now let's look deeper into the warrant dividend, because this is something you rarely see and it confuses a lot of people using individual brokerage accounts. In November 2025, Opendoor distributed warrants to shareholders. If you own the stock, you got these tradable options to buy stock at higher prices in the future. This does two things. First, it acts as a sweetener to keep you from selling. Second, and more importantly, it creates a complex capital structure that short sellers hate. It makes the stock harder and more dangerous to short because the float can theoretically expand if those warrants are exercised. But in the short term, it creates a loyalist base of shareholders who are now incentivized to see the stock price cross those warrant strike prices. Some are as high as $17 or $20. It's a psychological weapon as much as a financial one. It aligns the retail army with the management team in a way that a simple buyback never could. Let's transition to the business model for those who might be new to the ticker or only know it as a meme stock. Originally, Opendoor was simple. They were a digital pawn shop for houses. You wanted to sell your house? You went to their site, typed in your address, they used an algorithm to give you a cash offer, and if you accepted, they bought it. They charged you a fee, did some paint and carpet work, and sold it. When home prices were going up 20% a year, this was a money-printing machine. They made money on the fee and the appreciation. But when the market turned, they got stuck holding thousands of depreciating assets. They were losing money on every house. The new business model is subtle but distinct. They are moving toward Opendoor exclusives and a marketplace model. Imagine you want to sell your house. Opendoor now says, hey, instead of us buying it and taking the risk, we will list it on our private marketplace where we have thousands of buyers, including institutions like BlackRock or local landlords, ready to bid. Opendoor facilitates the transaction, takes a cut, and this is the key, they don't necessarily have to take the house onto their own balance sheet. They become the matchmaker, not the principal. This is the Uber for real estate model that investors have wanted for a decade. If they can pull this off, they stop being a capital-intensive construction company and start being a high-margin tech company. This is why you see comparisons to Apple stock in terms of ecosystem lock-in, or Schwab Intelligent Portfolios in terms of automated management. They want to automate the home sale. This pivot is why the Fidelity Investments and Vanguard funds of the world haven't completely abandoned the name. They see the potential for a monopoly on real estate data. Opendoor has more data on the off-market value of homes than almost anyone else. Zillow has data on listed homes. Opendoor knows what a seller will accept before it hits the market. That data advantage is the moat. However, we must address the bear case because I promised you a professional analysis, not a cheerleading session. The bear case